This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the datasets and the technical analysis for October 10th, 2025. And with that said, let's go ahead and head into tomorrow's data. Now, the data for the 9th, and yes, I know we're in a government shutdown, but I've kind of just spaced it because I've just been so exhausted. So I've been talking about a lot of these data sets and everything coming out when nothing's coming out. Okay. Thursday the 9th, we did have the 30-year bond auction. It did pull up slightly in yield. Now, that is a fairly large yield increase, but it's nothing, I would say, unexpected. If we pulled up to the 4.8%, then I'd be actually pretty worried. Now, I didn't get a chance to listen to any of the speeches today. I'm not sure what Powell said. I'm not sure what really anybody said. But just based on what I saw with the market, everything is fairly okay. Other than we are seeing the credit spreads and the risk market starting to really shift quite a bit. Now, for tomorrow, October 10th, it is OPEX, I believe, or is next week OPEX? Let's see. Next week is OPEX. Okay, so scrap that. No OPEX for tomorrow. Now, there won't be any of this data coming out, unless the government reopens randomly, which I don't think they will. It's very likely we're not going to be seeing the government shutdown ending until probably next week. They would have to cut a deal by tomorrow, 11:59 p.m. For any sort of deal to kick in over the weekend, and very likely that's not going to happen. I haven't been following the shutdown news too much, but I do know that both sides are pretty far apart right now still. So unfortunately, it does look like we will be continuing the shutdown into next week. Now, with that said, that does mean that every week the shutdown happens, the GDP reduces by 15 billion roughly, give or take. We have over 750,000 workers right now that are furloughed, that are, potentially not going to be getting any back pay, which is, very frustrating. My brother is one of them, so I'm not very happy about that at all. Uh, but with that said, um, I don't think any of this data comes out tomorrow. The ADP, the BLS are both closed down until the shutdown is over. So very likely we won't see any of this data until the next data set comes out. So yeah, we'll talk about that more in the next data for next week anyway. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. And getting into the technical analysis, let's quickly go over the moving averages and the Bollinger Bands. Now, the market closed at 671.16 today. Hold on, I just want to see the high and the low of the day. So we did have a high of 673.94. That puts us basically at the upper bounds of the 5 mile, down to 669.21. That's the lower bounds of the 5 mile. Okay, sorry, I was just trying to get this through my head really quick. All right, so the market closed at 671.16. And the 5 mile is currently at 670.84. So very likely that's going to move up, fraction of a few cents. It might pull up to that 671. It may not. It might pull up to the 670.90. I wouldn't expect much of a change, basically. Now, with that said, the market is really sticking to the 5 mile right now, and I believe the majority of that reason is because of the government shutdown. I'm going to cover the moving averages and everything in a little bit here, but we have this very, very heavy consolidation period here. And I do believe this is because of the government shutdown. We don't have a lot of news coming out. We don't have a lot of data coming out other than some of these Fed speakers. So there isn't a lot for the market to really grab onto to push upward or downward, if that makes sense. Now, with that said, the 5 mile will be basically around that 671 range tomorrow. That means the upper bounds of the 5 mile will be at that 673, and the lower bounds of the 5 mile will be at that 669. So essentially very close to what we had today for those levels. The upper Bollinger is coming very, very, very close to us now. As you can see, we're heavily consolidating within this range. That means that everything is just pulling together. We're having the upper Bollinger pull together. We're having the lower Bollinger pull together. The moving averages are getting tighter. So that's what I really mean by that consolidation. Okay, there's no real major move occurring yet. Now, with that said, the upper Bollinger is at that 675, so it's literally only $2, $3, $4 above us, depending on what the overnight pre-market and everything does. Now, the 20 mile is currently at 664, so even that is not that far away. That's only a full $7, $8 below us. But if we continue tapering out on the top here, and I always discuss this between the upper Bollinger in this 5 mile range is pretty dangerous area if the market doesn't grab for one of these levels. Now, the market has been grabbing for this 5 mile, but remember what the implications of that means. Generally, the 5 mile is tested or the level is taken so that it can be used for momentum to push upward or downward. Okay, so if we're just continuing testing the 5 mile here and everything's pulling together tighter and tighter, that's saying a very, very large move is getting ready to occur. Um, the upside move is really starting to taper out. Now, the reason why I say that is because the upper Bollinger and everything, while it's still moving up, it doesn't have this very expansive range from us. It's not like back when the market was at 662 and the upper Bollinger was all the way at 670. That gave us a whole $10 range above us compared to right now where we only have like $3. Now, if we do push the upper Bollinger, we will push basically up into that 677, 678, potentially even 680 range. Because remember, with upper Bollinger pushes, you have to take the level on close or above it. So if the upper Bollinger is at 575, we need to close basically at 575.50 or above to really solidify that, yes, the market wants that upper Bollinger move. So with that said, if we go for the upper Bollinger, just be prepared that very likely we will be pushing well above the upper Bollinger. I don't think the 680 is unreasonable at all here. Just remembering how upper Bollinger moves work, we go for the day one, higher, the day one high essentially, and then the day two higher high. So a push from here, extremely, extremely likely would tag that 680 range. Okay. Now, with us consolidating here and everything else, and remembering how the 5 mile is used to push, but also what comes from the 5 mile is either the upper Bollinger push or the 20 mile push. If we don't get that push to the upper Bollinger, which we've been consistently rejecting in here, then that does heavily imply that we're very, very likely going to get this 20 mile push very soon here. And I'm going to discuss why that's very likely going to occur in a couple minutes, but I do want to go to the 4-hour chart just to show structures first. So going over the 4-hour chart, let's see what we got for structures. Now I am going to pull up the drawings. I don't know what we got going so far. Okay, so potentially we have this head and shoulders. I'm going to delete that for a moment. Alright, so let's just kind of go over this here. We discussed in the videos this week how there was potentially a head and shoulders right here forming. There was maybe the head, and then looking for that right shoulder. Well, that led into a breakout. Okay, and because of that, that turned into a cup. Now, that's great. That's a very good bullish structure. However, this cup handle, if this is a cup's handle, is getting very, very low. And it's only, let's see. Sorry, my mouse isn't going down very correctly. So essentially, if we tag that 667 range, this bullish cup that was right there will be invalidated, and it will be invalidated by this head and shoulders. Now, if we start bouncing upward here, then what we would be looking for is the cup, and then obviously the handle. And I know that doesn't look very well, but you can tell what I'm trying to draw. If that cup and handle doesn't play out, then the extreme likelihood is we're going to get that head and shoulders straight down towards that 20 MA range. Now the 20 MA, and let me double check where the level is because I forgot. 20 MA is currently at 664.36. So in tandem with that channel, the bottom of this consolidation channel is at 667 or 666.70, excuse me. So we would expect a move potentially all the way down towards that gap. Okay. And what does that also align us with? That aligns us with the bottom of this buying channel. Okay. So this is kind of the bear thesis right now is looking for the move downward to test the 20 MA. Now from that 20 MA test, and let me be very, 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 very clear, this 663 range, if we head down to that 20 MA, you need to buy calls. Okay, it doesn't matter if you are the most bearish bear in the world, it doesn't matter. And the reason why it doesn't matter is because we are in an extremely strong buying channel. It does look like it's starting to taper a little bit, but you have to respect this channel. Each time we've even remotely touched the 20 MA within the last, previous 3-4 months now, they have been in that level for less than 30 minutes to an hour, and then run all the way back to the upper Bollinger again. And that upper Bollinger move is usually a whole week or two straight. So that's the kind of implications that you have to look for, is that if we do have that push downward, you need to set up some calls for the upside. Even if you're going to continue your position downward, you need to be prepared for that upside, because there's a very, very, very large possibility that they take that liquidity and start heading upward again. Okay. Now, overall, I am bearish. Okay, I've been bearish for, I've been stating that they have not given us a very strong support test since the essentially the early 600 range. And because of that, I have been shorting every upper Bollinger move, the day two, and looking for a real 20 MA support test, and we have not had that. So that's why I've been bearish, and that's why I've been considering the market as running hot. Now, I do need to pull up the actual data set. I've been saying I need to for a week now. I will try to over this weekend, but there's this data set in here where we're in the either second or third top rally of all time, where we are, I believe, 91 or 92 days straight now of consistent buying without a 3% or more correction. Okay. Very, very, very rare throughout the entire market. So there are a lot of reasons why we're overextended. Another reason why we're overextended is there is the TDF glide path, which I've discussed in the past, which is essentially how large all these super, super large investment firms and everything set up their portfolios to have a natural glide upward or downward. So every dollar inward or outward will automatically invest into equities, bonds, etc., etc. Now, the equity weight right now is usually supposed to be at 50%. Currently, it's, well, back at 615, it was at 53%. Now it's all the way close to 56 to 57%, which that means there's a whole 7% of equities that needs to be sold off from the top. Uh, so that's what I mean by the market is heavily overextended. And that's not by my metrics, that's by actual just major investment firm metrics. Okay. Now, another thing I do want to discuss is the HIG, because it is finally starting to see some selling days. And what is something we generally see, and I'm going to delete this head and shoulders because that was invalidated. What is something we see within HIG when we start seeing selling? Usually corrections, okay? Usually HIG is one of the best indicators of corrections, and the reason why is because this is the high yield debt um, for corporations. It's essentially the most guaranteed yield that has a risk to it that you can have. And not just HIG, there's a lot of HIG-based assets out there where they're structured very similar to HIG, where it's essentially the junk bonds. Now, the implications of HIG selling is that the quote unquote junk bonds, the high yield bonds at the top, are no longer worth that risk. Okay, and remember, this is a world where every single percentage point of yield matters, and when the high yield risk is saying, no, we need to sell off, this isn't worth it anymore, that becomes a very serious concern for equities, because generally what happens with the treasury market, the bond market, etc., happens to the equity market. If the risk is selling off at the top levels, the very top echelons of the you know, least amount of risk asset you can have out there that's guaranteed yield. And they're saying that this is, too risky now, then generally equities like to follow. Now, you can follow this chart, and I'm not going to go over it right in this video, but every time major selling within the HIG happens, there is major selling within the S&P. Now, have we experienced major selling within HIG? Not really, okay? We have been seeing the inflows and outflows on HIG being absolutely absurd. Now, I've been seeing the buying and selling on both ends, but specifically the buying end has been within the 700 billion to 1 billion plus mark almost each and every day. Now, granted, those are for NASDAQ flows. Those are not tracking, any dark pooled activity. That's not tracking anything that's not on NASDAQ, which there can be plenty of those that are set up. So there could be billions of dollars of selling within HIG that I'm just personally not able to see because I don't have that data right now. Um, but with that said, I've been seeing billions of dollars of buying inflows into HIG each and every day. I don't know what to really make of that because I've been watching HIG for an extremely long time now, for a few years, and I have never really seen that type of activity. Even before like last correction, I didn't see massive inflow buying into it. Um, if we're going to have some major correction here, then this buying is very strange to me. I didn't even see this type of buying back when the actual massive dip buying was occurring. And it's concerning. But, you know, the price is showing that the fund itself is destroying units, which that's how these funds work. If you redeem your shares, the fund will take those shares and, essentially quote unquote delete them, destroy them, and absorb it into the fund to, you know, balance the whole weight of the fund. Now, I haven't been tracking the total assets on HIG if it's been increasing heavily or not. I do know that there has been a few NASDAQ outflow alerts on HIG over the past few weeks. There has been one major inflow, which was that $1 billion one. And even today, just looking on my Weeble thing, I think it was over $1 billion of buying in the HIG. Let me just take a look really quick. Not that it actually means anything, because remember, a lot of this can be dark pooled, but it's concerning when you see 1.16 billion dollars worth of worth of buying inflows compared to 61 million or 610 million of selling. So just a little weird. Um, But again, a lot of that selling could be through the dark pool because this is a major BlackRock fund. This isn't usually traded by retail. This is generally traded heavily by institutional traders. So institutional traders generally aren't going to be pressing the sell button through a brokerage app like Webull. Usually they're going to be picking up the phone and having BlackRock just, pay back their shares or whatever they do with them. Um, so yeah, that's something to think about. Now, the ADL, I still haven't been able to adjust my chart yet. I apologize. The ADL has been pulling down very, very heavily. Um, just over the last, I want to say week and a half now on the ADL, it's gone from 1.79 billion down to 1.64 billion. So it is showing that essentially 200 million worth of actual selling is occurring compared to the buying versus selling. Um, so it's something to think about. With that said, I do think I want to end the video here. My next video very likely will be on Sunday, but I do want to kind of put out a video very likely tomorrow night where I want to discuss sort of my thoughts on the whole tech rally, what's happening with gold, what's happening with treasuries, something that I can't really do in one of these quick nightly videos. So that might be coming out tomorrow if I feel well enough. I've been really struggling with my fatigue, but I've been working on it. But it's a step at a time. So thank you for watching. I appreciate you all for the support as always. Um, Before we go, let's just quickly take a look at the VIX. The VIX volatility was up quite a bit today, but it wasn't up massively. It did not push above that 98. Remember, it needs to really sit above the 98 plus to signal selling. So just be aware of that. If you are expecting major bearishness, you really need to have this on your watch list. It's VVIX. It's not just the VIX itself. This tracks the VIX volatility. So if there's a lot of people buying VIX contracts and VIX calls, this will start to spike. That is how this tool works. It's specifically built for that. What else? Um, Let's see what the actual VIX has been. The VIX has been still following our pattern. I believe I mentioned this in last night's video, but it still has been following that upward curve. It does not look like it's pulling back down just yet. Um, it's at 1643. Generally, you want it above 20 to really signal that volatility is within the market, but that can shift a little bit. I really would look for that 20 range though to really signal that yes, things are going to start selling. Because remember, we've been touching the 20 mall on the SPY just for 30 minutes to an hour and then absolutely soaring from that level. So just be cautious, be aware that you know selling doesn't really mean selling unless they actually are selling shares. Um, And I know that's a hard concept right now if you haven't been following what I discuss and everything. But nobody has really been selling their equities throughout this entire rally. There was only two sessions, which was, I want to say it was this one right here, and it was this one, no, it was this one right here, where there was those two news events that there was a little bit of selling in the actual equities, but since then there's been no selling. All these events have just been very derivative, options chain related stuff, and yeah. So that's the video. I'll talk to you all on Sunday evening, but again, I will try to put out a video for tomorrow night going over the overall macro of the market and everything. With that said, I hope everyone trades safe tomorrow. Have a wonderful night or day or whatever time it is for you. Um, I'll talk to you in the next video. Thank you for supporting me, and yeah, have a great time. Thank you.